The SEC doesn't send friendly reminders about compliance failures. They send 143-page enforcement actions that can end your bank's existence. $340 million in hidden risk exposure because compliance officer banned fear-based language. Risk reports rewritten to say ambitious growth instead of dangerous concentration. SEC examination finds material weaknesses in every single risk category. Be me, 44, senior risk analyst at Regional Bank in Charlotte. 16 years building risk models that kept us safe through 2008 crisis. About to watch Chief Compliance Officer destroy everything we built because she decided the word risk was patriarchal fear-mongering. Here's how inclusive compliance framework nearly got our banking charter revoked by federal regulators and turned a safe community bank into an $85 million SEC enforcement action. Need to establish what we had before it was destroyed. This context matters for understanding what was lost. Piedmont Community Bank, regional institution in Charlotte, North Carolina. Founded 1983, 40 years serving the community. $8 billion in assets, 35 branches across 3 states. 600 employees, deeply rooted in local business community. Our reputation, boring but safe, conservative but reliable. We survived 2008 financial crisis when bigger banks collapsed. How? By being extremely careful about risk. Conservative lending standards, strong capital ratios. Avoided subprime mortgages, avoided complex derivatives. Stuck to what we understood. Commercial lending, residential mortgages. Made money slowly and safely. Exactly what regional banks should do. I'm senior risk analyst, effectively deputy chief risk officer. Age 44, been with bank for 16 years, started right after 2008. Making $165,000 annually, responsible for risk modeling and monitoring. Build the mathematical models that predict loan defaults. Monitor concentration risk, track capital adequacy. Report to board's risk committee on potential problems. My job is to find problems before they become disasters. Quantify risks, set limits, trigger warnings when limits are breached. It's technical work, lots of statistics and probability. But fundamentally, it's about keeping banks safe, protecting depositors, maintaining regulatory compliance, ensuring we don't take risks we can't handle. For 16 years, this worked perfectly. We had clear risk frameworks, explicit limits, direct language. When something was risky, we called it risky. When exposure was too high, we said so clearly. No ambiguity, no softening, just facts and numbers. 2023, bank is doing well financially. Profitable, well-capitalized, good loan quality. But board is concerned about reputation and growth. They hire a consulting firm to assess our organizational culture. Consultants spend 3 months interviewing employees, reviewing policies, observing operations, analyzing structure. October 2023, they present findings to board. Report says bank culture is excessively conservative and risk-averse. Masculine-coded language dominates risk discussions. Fear-based framing prevents innovative growth opportunities. Bank needs to modernize culture to attract diverse talent. Board takes this seriously. They want better ESG scores. Want to be seen as progressive, modern, inclusive. Decide to hire Chief Compliance Officer focused on cultural transformation. Someone who can modernize our approach while maintaining safety. November 2023, Board hires Dana as Chief Compliance Officer. Age 39, comes from Big Four consulting firm. Background in ESG consulting and corporate culture transformation. Huge LinkedIn following, 50K plus followers, regular conference speaker. Known for work on inclusive compliance frameworks. Zero experience in banking or financial regulation. Never worked at bank, never dealt with federal regulators. But board loves her vision for cultural modernization. Making $220,000 annually, reports directly to CEO. I meet Dana during her first week. I'm briefing her on risk framework, explaining our value at risk models, concentration limits, stress tests. She's taking notes, asking questions, seems engaged. Then she asks, "Why do you use such aggressive language? What do you mean by aggressive?" Terms like adverse, scenario, critical exposure, kill, switch. This language creates fear-based culture. Those are standard risk management terms used industry-wide. That's exactly the problem. Industry has normalized patriarchal framing. I'm confused. These are technical terms with specific meanings. Adverse scenario means economic downturn in our stress tests. Kill switch means automatic limit that stops trading when breached. But they sound violent and fear-based to stakeholders. They're accurate descriptions of what they do. She's firm. We need to evolve past this language. Create inclusive framework that doesn't rely on fear. Red flag, but I figure she's just getting oriented. Learning the business, understanding our operations. December 2023, Dana announces her initiative. Company-wide meeting. She presents inclusive compliance framework. We're transforming how Piedmont approaches risk and compliance. Moving from fear-based patriarchal model to inclusive partnership model. Shows slide deck with new terminology guidelines. Aggressive risk exposure becomes ambitious growth focus. Adverse scenario becomes challenging market moment. Credit deterioration becomes portfolio evolution. Kill switch becomes calibration point. Material weakness becomes opportunity for enhancement. I'm sitting there thinking this is insane. These aren't cosmetic changes. They change meaning fundamentally. Aggressive risk exposure means dangerous concentration. Ambitious growth focus sounds like a good thing. After meeting, I go to CEO William's office. William is 58, been CEO for 12 years, generally competent. But he's terrified of bad publicity and obsessed with ESG scores. William, this terminology change is dangerous. Risk language exists for precision and clarity. When we say something is high risk, people need to understand severity. He's dismissive. Dana is compliance expert. Trust her judgment. Regulators love inclusive culture. This helps our examination ratings. Regulators care about risk management, not terminology. They care about both. We could do both. I'm not convinced, but he's made decision. January 2024, Dana implements the framework officially. All risk reports must use new inclusive terminology. I'm required to rewrite my monthly risk dashboard. Old version. Alert. Commercial real estate concentration exceeds limit. New version. Commercial real estate portfolio showing dynamic growth focus. Old version. Credit quality deteriorating in corporate loan book. New version. Corporate lending portfolio experiencing evolutionary phase. I bring this to CFO Thomas. Age 52. He's financially sophisticated. Thomas, look at these rewrites. They obscure the actual risk. I'm trying to warn that we have concentration problem. New language makes it sound like everything is fine. He reads both versions, sees the problem. You're right. This is concerning. Bring it to risk committee. I already tried. Dana said my language was fear-based. I'll talk to William about preserving technical accuracy. Nothing changes. Dana's framework is mandatory. February 2024, we start seeing actual risk problems emerge. Commercial real estate lending has been growing rapidly. We're up to $1.2 billion in CRE loans, 15% of our total assets. Our internal risk limit is supposed to be 12% maximum. This is concentration risk, too much exposure in one sector. If CRE market has problems, we're overexposed. I run the numbers. We're violating our own risk limits. Write risk report flagging this. Critical. CRE concentration at 15%. Exceeds 12% policy limit by 25%. Immediate action required. Dana edits my report before it goes to board. Her version. CRE portfolio demonstrates ambitious market positioning. Current allocation of 15% reflects strategic growth focus. No mention of policy violation. No mention of limits exceeded. Just sounds like we're doing good business. I escalate directly to Risk Committee Chair Margaret, age 61. She's board member with banking background, should understand. Send her both versions, my original and Dana's edit. Margaret, Dana is removing critical risk warnings from reports. Board isn't seeing actual risk levels. This is dangerous. Get response from Dana, not Margaret. Your communications with board must go through proper channels. I've reviewed your concerns and determined they reflect patriarchal framing. Please use inclusive language in all future risk communications. I'm being boxed out of my own risk reporting function. March 2024, problems accelerate. Not just CRE concentration. Now we're seeing credit quality issues. Several large corporate loans showing signs of stress. Borrowers missing payments, requesting modifications. Default probability in my models is tripling. Corporate loan book has $340 million in what I classify as high risk. These are loans rated BB plus or lower, junk territory. Our policy says maximum 5% of capital in below investment grade. We're at 18% of capital, massive policy violation. I write detailed memo to William and Risk Committee. We have material risk exposure that violates multiple policy limits. $340 million in concentrated high-risk corporate debt. CRE concentration at dangerous levels. Credit quality deteriorating across multiple portfolios. Recommend immediate action to reduce exposures. Dana intercepts this memo, calls me into her office. This memo is completely inappropriate. Your language is alarmist and fear-based. You're trying to sabotage our inclusive framework. I'm reporting risks that exist. That's my job. Your risks are subjective interpretations based on patriarchal assumptions. No, they're mathematical probabilities based on loan data. She shows me her rewrite of my memo. All the specific numbers removed, all the warnings softened. Portfolio experiencing dynamic evolution within strategic parameters. Management monitoring developments and optimizing allocation. Nothing about policy violations. Nothing about concentration limits. Just corporate speak that means nothing. This doesn't communicate the actual risk to the board. It communicates an inclusive way that doesn't create panic. Risk management sometimes requires creating appropriate concern. That's patriarchal, fear-based approach we're moving past. April 2024. I'm removed from direct risk reporting. Dana tells William I'm not aligned with inclusive framework. He's stuck in legacy risk mindset, can't adapt to modern approach. I'm reassigned to model documentation and technical support. Basically demoted, no longer presenting to board or risk committee. Dana takes over all risk reporting to board. Her reports are beautifully formatted, full of inclusive language, and completely useless for understanding actual risk. I watch from sidelines as exposure continues growing. Nobody is stopping the CRE concentration. Nobody is addressing the corporate loan quality problems. Because Dana's reports make everything sound fine. May 2024, the inevitable happens. SEC announces routine examination of a bank. This happens every few years, standard regulatory process. Examiners come in, review operations, check compliance. Usually takes 4 to 6 weeks, find minor issues, we fix them, done. Lead examiner is guy named Robert, age 49, career SEC examiner. He's seen everything, knows banks inside and out. First week is document review. They're reading our board reports. I see Robert reading Dana's risk reports, see his expression change. Second week, Robert requests meeting with risk management. Dana and I both attend, along with William. I have concerns about your risk reporting. The language in your board reports is unusually vague. Can you provide specific concentration numbers and limits? Dana responds, We use inclusive framework for risk communication, designed to provide strategic context without fear-based framing. Robert is direct. I don't care about framing. I need numbers. What is your current CRE concentration as percentage of assets? I start to answer. Dana cuts me off. Our CRE portfolio is strategically positioned for growth. Robert's voice gets harder. That's not a number. What percentage of your assets are in commercial real estate? Silence. Dana doesn't know the number. She never looks at numbers. I answer, 15.2% as of last month. Robert writes this down, and your policy limit is 12% maximum, I say. So you're over your limit by 25%. Who approved this exception? Dana tries to explain. The limit is guideline, not hard constraint. Portfolio evolution sometimes requires strategic flexibility. Robert is not buying this. Show me the risk committee approval. The exception to policy limits. Where's the documentation? Dana can't produce it because it doesn't exist. We violated limits without ever formally recognizing the violation. Her reports never said we exceeded limits, so board never approved exception. Third week, Robert digs into our corporate loan book, requests loan level data, credit ratings, default probabilities. I provide him my models, the actual risk numbers. Not Dana's inclusive language version, the real technical analysis. Shows $340 million in high-risk concentration. Shows we're violating capital allocation policies. Shows credit quality deteriorating faster than we're reporting. Robert calls another meeting, this time just me and him. Your internal models show significant risk exposure. Why doesn't this appear in your board reports? I explain the whole situation, Dana's framework, the language changes. Show him examples of my original reports and Dana's edits. His expression is grim. This is material weakness in governance. Board isn't receiving accurate risk information. Your compliance officer is actively concealing risk from board. That's when I know we're in serious trouble. Material weakness is technical term, means fundamental control failure. SEC uses it when banks' risk management is critically broken. June 2024, SEC completes examination. Requests exit meeting with full board and executive team. Everyone is there. William, Thomas, Dana, me, all board members. Robert presents preliminary findings. He's not gentle. We've identified material weaknesses in multiple risk categories. Risk governance, compliance oversight, board reporting. Your risk exposure exceeds policy limits in CRE and corporate lending. Board has not been properly informed of these violations. Your compliance framework has obscured rather than clarified risk. Shows examples of Dana's rewrites next to original risk data. Board members are shocked. Margaret looks furious. She's reading the side-by-side comparison, sees what Dana did. We were told portfolio was in strategic growth phase. We weren't told it violated concentration limits. Robert continues. SEC is drafting enforcement action. We're recommending significant civil penalties, plus consent order requiring enhanced oversight. Preliminary estimate of fine is $85 million. Room goes silent. $85 million is enormous for our bank. That's nearly 10% of our capital, materially significant. William tries to defend. We implemented inclusive compliance framework in good faith effort to modernize our culture. Robert cuts him off. Your compliance officer buried material risk warnings. That's not culture modernization. That's control failure. You violated your own risk policies for extended period, and your board wasn't informed because reports were rewritten. He pauses. We're also considering whether to recommend charter review. Charter review means potentially revoking banking license. That would shut us down, force liquidation, and the bank. July 2024, SEC formally issues enforcement action. 143 pages of findings, violations, required remediation. Everything Robert warned about, now official and public. $85 million civil penalty for material control weaknesses. Consent order requiring independent risk management for 5 years. Public disclosure required. This hits news immediately. Stock price drops 60% in one day. We're publicly traded small regional bank stock. Drops from $28 to $11 per share on the news. Depositors start withdrawing funds, worried about bank safety. $400 million in deposit outflows over 2 weeks. This forces us to sell securities at loss to raise cash. Our capital ratios drop dangerously low. Federal Reserve and FDIC get involved, express concerns. Board convenes emergency meeting. William is first to go, resigns as CEO to spend time with family. Nobody believes that. Everyone knows he was forced out. Thomas is fired as CFO, scapegoated for financial controls. Dana quietly resigns before she can be fired. Announces she's pursuing other opportunities. No mention of the enforcement action or control failures. August 2024, bank is in crisis mode. Need to raise capital urgently to meet regulatory minimums. Only option is merger. Find larger bank to acquire us. Several banks look at us, see the SEC action, see the problems. Finally get offer from larger regional bank. They'll acquire us for $12 per share, below current trading price. It's a fire sale. We have no negotiating power. Merger means loss of local control. 200 employees laid off, including most of corporate staff, including me. 40-year-old community bank effectively disappears. Absorbed into larger institution, becomes branch network. September 2024, I'm unemployed. Resume out to banks and credit unions. Market is tough. I'm 45, mid-career, associated with failed bank. Even though I try to prevent the failure, still looks bad on resume. Takes 6 months to find position. Finally hired by credit union as risk manager. Making $125,000, $40,000 less than bank job. It's come down, but I need the work. Dana resurfaces on LinkedIn, remarkably unscathed. New title, Independent Compliance and Culture Consultant. Helping organizations navigate backlash from legacy finance culture. She's positioned the entire disaster as vindication. I try to modernize banking culture, but old guard resisted. No mention of SEC enforcement action or control failures. Just narrative about how traditional finance rejected innovation. She's getting consulting engagements at $15,000 each. Speaking at conferences about inclusive compliance. Building brand as thought leader who is ahead of her time. Meanwhile, 200 people are unemployed. $85 million was paid in fines to SEC. Community lost local bank that served them for 40 years. All because compliance officer decided risk warnings were patriarchal. Now, it's March 2025, 9 months after the merger. I'm settled in a credit union role. It's fine, pays bills. But I'm making $40,000 less and doing less interesting work. Margaret, the board chair, reaches out to meet for coffee. She's retired now, no longer on any boards. We talk about what happened. She's still processing it. I should have seen what Dana was doing. Your risk reports used to be clear and direct. Then they became vague, and I didn't question why. You questioned it. Dana told you I was being alarmist. I believed her because she spoke confidently about compliance. But she didn't know anything about banking. Margaret continues, the consultant report told us we were too conservative. We took that as criticism, tried to fix it, hired Dana to modernize our culture. Never considered that conservative was appropriate for banking. She's right. That's where it started. Board saw conservative as problem to be solved, when conservative risk management was our competitive advantage. It's what kept us safe through 2008 when others failed. But consultants framed it as weakness, as excessive caution. So board hired someone to fix what wasn't broken. And she destroyed what was working in name of modernization. April 2025, I see Dana featured in Banking Trade publication. Article about the future of compliance in banking. She's quoted extensively about inclusive frameworks. Traditional banking culture is rooted in patriarchal fear-mongering. We need to evolve past aggressive risk language. Build compliance models based on partnership and understanding. Article doesn't mention Piedmont Community Bank. Doesn't mention $85 million SEC fine. Doesn't mention material weaknesses in governance. Just presents her as innovative thinker. Read comments section. Industry veterans are not fooled. This approach nearly destroyed a bank. SEC enforcement action says everything about these methods. Compliance isn't about feelings, it's about controls. But she has supporters too, people who like the message. They don't know the details, just hear inclusive and approve. Now it's present day, 2 years since Dana was hired. Piedmont Community Bank doesn't exist anymore. Absorbed into larger bank. Name retired, history over. 600 employees became 400, 200 lost jobs in merger. I'm at credit union making $125,000 instead of $165,000. Dana is consulting, making probably $200,000 with speaking fees. She failed catastrophically, but failed upward by controlling narrative, positioning herself as victim. Margaret and other board members quietly retired. William is unemployed, reputation destroyed. Thomas found controller job at smaller bank. The only vindication is SEC enforcement action. Official federal document saying what we did wrong. Explicitly citing material weakness in risk governance. Inadequate board reporting due to compliance framework. It's in public record, permanent documentation. That Dana's inclusive compliance framework was control failure. Not innovation, not modernization, just failure. But most people don't read SEC enforcement actions. They read LinkedIn posts and conference presentations, where Dana is expert on inclusive compliance. That's the frustrating part, watching her succeed. After causing disaster that ended institution. But I learned several lessons from this experience. First, risk management language is precise for reason. Calling something high risk communicates severity clearly. Calling it growth, focus, obscures the danger. Second, compliance is about controls, not culture. Compliance officer's job is ensuring rules are followed, not making people feel included or empowered. Third, board must demand clear risk information. Vague language in risk reports is red flag. Should trigger questions, not acceptance. Fourth, banking regulations exist for reason. Concentration limits, capital requirements, these protect depositors. Violating them isn't strategic flexibility, it's dangerous. Fifth, some people fail upward by controlling narrative. Dana turned control failure into consulting career by reframing her failure as visionary thinking. Most important lesson, numbers don't care about politics. You can rename risk to challenge all you want. When losses hit, they still add up the same way. SEC doesn't care about your inclusive language. They care about whether controls work, whether board is informed, whether policies are followed. Piedmont learned this the expensive way. $85 million fine expensive. 200 jobs expensive. 40-year institution expensive. All because we hired compliance officer who thought risk warnings were patriarchal and rewrote them into meaningless corporate speak until regulators noticed board wasn't being informed and issued enforcement action that ended the bank. That's my story from inside Piedmont Community Bank, where inclusive compliance framework met federal banking regulations and lost catastrophically, leaving me making $40,000 less. Dana making $200,000 consulting, and 600 employees working for different bank because someone decided that the word risk was too aggressive and needed to be softened into language that didn't scare people, even when there was something worth being scared about, like $340 million in concentrated exposure, hidden behind words like strategic positioning, until SEC found it and ended everything.